Now we can turn towards some internals as we look at economic data within the U.S. and what does it mean and kind of projecting as we head into 2021. The bigger one that we want to talk about here is retail sales, because retail sales have started to weaken over the last couple of months. Yeah, and they were still positive in previous months, but they started to turn negative and missing estimates. And now the retail sales advanced month over month is down 1.1%. Survey was down 0.3%. And the prior month was revised down from 0.3 to negative 0.1. And again, these are the things that we continue to see as bigger pressure points as we go forward. And then when we look at the control group, the control group was supposed to be a growth of 0.2%, came in at negative 0.5%. These are types of problems because the U.S. economy or GDP is driven 70 to 75% by the consumer. And this is just showing you where the consumer sits and what their buying aspects have been. Now, November was getting weaker. It was below the previous month. Like October, we continue to see these walkbacks. And now as we head into the kind of the last final push of the holiday season, it's tough to see some of these recoveries. And this is really kind of showing you just the pressure that the underlying consumer is under as we continue to see this kind of pare back. The market PMI, we had a little bit of a surprise to the upside on the manufacturing side at 56.5. Service PMI, a little bit to the downside. Composite, again, we're still in a growth projection. Things are starting to slow a little bit, but on the positive side, we're seeing a little bit of an uptick in employment expectations, which is a positive. But the one thing that isn't covered here that is out here is the business inventories continue to tick higher. The expectation was for 0.6, came in at 0.7%. The prior was revised up, and again, as we talk about inventory levels starting to get back to normal, which is going to put pressure on just the overall imports that we're seeing and just what that intermodal is going to look like as it kind of moves through the system as we catch back up with ourselves. And then the housing index started to kind of pull back a little bit. FOMC came out. Things are fairly stable. There's the rate decision's the same, rate decision upper band, lower band. The projected target is the same. The bigger thing that we have right now is the Fed is going to continue to buy bonds at $80 billion a month and MBS or mortgage-backed securities at $40 billion a month. Again, coming to your net total of $120 billion of purchases. Again, Fed just can't stop, won't stop. And now this is, these retail sales are starting to kind of point to why the fiscal side. So obviously FOMC, Fed is the monetary side. The fiscal side, we're going to see some additional support with the likely stimulus being something about $900 to $925 billion. Now, as we go through to economic indicators, the New York Fed weekly economic indicator pulled back a little bit, back to about, let's call it negative, about negative 2.3. GDP hasn't updated, but the industrial production is the year-over-year change, and you can see that we're still below that drop, and we're starting to cool, and we're starting to get a little bit to the downside. We're still negative, and that is, I think, the bigger issue as we go forward, is because we are getting this PMI pop, which is an aggregating number as we look backwards, but we still haven't been able to get back to where we need to be to see this growth. Now, are we an industrial nation or a service nation? We're a service nation. We've already made that pivot. But again, these are things where even the service side remains a little bit, remains on the softer end, which is just, again, putting weight on the overall economy as we're looking to go into next year, with jobs still continuing to disappoint to the downside. So Empire Manufacturing, this kind of sums up what we've been talking about, where general conditions have gotten worse, but again, the the number of employees has gotten better, which has come to the positive on hiring. December Empire Manufacturing a bit softer at 4.9% versus an estimate of 6.2%. But at the same time, again, the employment side is a positive to see. It's just we haven't seen it translate yet into actual hiring because we still see these disappointing numbers. And it's also a tale of two two cities that we keep talking about is the balance sheets on the liquid side, because there's some charts going around that, corporations are the strongest they've ever been on the liquid side, as we've seen debt get issued, we've seen equity get issued, and we've seen, PPP loans, but it's lopsided. The large corporations are fine, liquid, more liquid than ever. It's the small businesses that continue to struggle. And this is why when we look at small business revenue by city, you can see that it's just congregating around this, either down 60% to down 30%, and it's across the board. We're not seeing any one spot that's a bright spot. It's just we continue to see this revenue, and what does this mean? It means less tax dollars. It means more places that are going to have to shutter. It's going to mean more places that just are going to go out of business, that is going to impact this specific region's unemployment numbers, and unemployment is going to continue to go higher based on some of these factors, because some of these companies just are going to either need government support, or they're just going to be forced to go bankrupt, or just shutter their doors. Now, when we look at industrial production in current versus previous cycles, you can see how quickly things have gotten back to normal. This is where it's a matter of now the pace. What does the pace look like as we look to get back to normal, come out of this recession? You can see what 2008 looked like, how quickly how long it took, and we're starting to see this pretty aggressive slowdown, which again isn't abnormal. It's not not abnormal to see these type of slowdowns and to see the slope kind of balance out. It's just going to be a matter of how that slope is going to be indicative of how quickly can we kind of get ourselves out of this this slump. And we already have the Fed pumping in $120 billion a month. We already have the Fed, or the central the government, that has pushed $2 trillion into the market with more to follow. It's going to come to a point where we're going to have to let economic cycles take hold, but there still remains fear of actually letting that happen. So here's where we look at U.S. capacity utilization and industrial production. So industrial production was up 4% in November. Manufacturing was 0.8% on a broad basis. Gains in motor vehicles was 5.3%. But again, some of these motor vehicle, it happened. It was part of the first wave. Some of those things start to slow down. But then when we look at year over year, so utilities is down 4.3% year over year. Industrial production is down 5.5% year over year. Manufacturing down 3.7% year over year. So that's, again, this is where we're starting to not only see the slope kind of cool off, but we're also seeing some of this rollover in industrial production, which is just going to put essentially a headwind on this capacity utilization and how quickly we can get this economy back up on its feet, even with the extensive amount of easing that we've seen and stimulus that we've seen come into the market. And this is just, again, another way of looking at the recovery of the progress that we've seen, and how we've had this sharp drop off on this 3-month average. With the Diffusion Index shows 66% of manufacturing sectors were in contraction territory in November. The 3-month average stands at 69%. So we still have a net contraction on the manufacturing side. Forward guidance, the PMI guidance, is looking better, but now when we take the 3-month average and we look out, we still have a general overhang as the recovery looks generally lopsided. And this is where we look at volumes coming to the U.S. So we keep hearing about how imports are coming in, how things are flowing through, but this is showing just the general malaise and the slowdown, how we've been hanging out between 10.2 million tons as we go into the end of the year. And just given that we've had logistical issues, we've had bottlenecks, it's just been difficult to see how this is cleared and how this is going to be really get into the regular market. Again, especially as we have consumers slowing down, purchasing slowing down, business inventory starting to normalize. That's why, when we look at just the stuff getting to the U.S. ports, it's going to slow down. As this slows down, what is the U.S. but the largest importing nation? If we're not importing as much, is somebody making up the difference? If they're not making up the difference and others are importing less, as we keep talking about the import market missing to the downside, Export market can only survive for so long until inventories are restored and the imports continue to remain at this level, which is why we continue to see a general concern on just activity overall. Japan missed export estimates. India missed export estimates. All of these things, and India went negative again on exports. These are the things that we're seeing, and this is just an idea. There's one snapshot of imports. The largest importing nation is just not importing as much as before, and it's been on a downward trajectory since 2018 as we're doing less and less importing, putting pressure on the global market. But with these moves, what do we have? We have an IPO frenzy, and we have this massive move to just issue IPOs, which, coming to what we talked about in the first segment, where the feelings are great and everybody's looking to capitalize. There is a ton of money sloshing around with the Fed pushing money in, banks having all this capital just because of what they see, what they're getting from the Fed. So IPOs are through the roof, and they continue to move higher. You can see what we're seeing from SPX August 1995 to July 1999, aka right before the tech bubble burst, and you can see that we're tracking along the same level. It'll be interesting to see if we have the same outcome. But when we look at the IPO frenzy, you have to look at, okay, well, the average first day return of IPOs is about 40%, which obviously is a fantastic return if you're issuing, but how many of them have negative earnings? And that is a bigger side of things. Nobody is making money. They're IPOing and they're not making any money. Now, you could say they're tech companies. There's a growth profile. They'll make money in the longer term, and which is fair. It's just a matter of, we've seen this song and dance before, and we're getting back to something similar. And we've been trending in a negative way where these companies just are earning negative earnings overall. So right now, just to put it into context, the latest IPOs have seen massive gains on first day of trading, as you can see, but still a bit far from record levels, which was during the pop. But 80% of IPOs have negative earnings, which is just slightly below 81%, which was the high in 2000 and 2018. So there it is. We're right on the cusp of all of these negative earning capacity, which is something to consider when you're looking at these first investments. But why is this happening? Because financial conditions are the loosest on record, and the pressure is going to remain on just making sure that this is as easy as possible. If you go back and read the FOMC statement, what it is, the fact that they're keeping buying the same, this is just saying that they're going to do everything they can to keep financial conditions the loosest possible, trying to keep money flowing into the system. And that's why when we look at bank lending conditions, you can see that it's fallen because people are now getting more and more willing to lend because they now have all of this excess cash sitting there. They've covered their bad debt expense. They've covered their concerns, and now they're being told, go out and lend. And you can see it coming back into large and middle market firms and small firms, and these guys are starting to get a certain amount of ability to raise capital through not only just loans, but also the bond market, which is why when we look at U.S. companies coming to the bond market, when we look at the liquidity on the balance sheet, investment grade, high yield bank bonds are at all-time highs, because why not? If I can issue debt at, let's call it, 100 basis points above the 30-year or 200 basis above the 30-year, why would I not do that 10 out of 10 times, given how cheap money is? And with inflation, expected to go higher, my cost of paying back will get less. I mean, we're just incentivizing the build out of additional bubbles, which is why we continue to see the growth of zombie companies not really projecting any form of growth of earnings, because how can you grow earnings given the pressure that we continue to see? But excluding PPP loans, U.S. banks have shrunk corporate lending. So even though they're getting easier to lend, we still haven't seen it hit the market yet, because all banks ex PPP. So you can see that the PPP loans made up a big portion of it, and now we're actually negative in terms of all banks ex those specific government-backed loans. That is starting to turn back positive, which is why the Fed continues to be easy on money, incentivizing additional lending, making standards easier, and increasing the amount of cash on the balance sheet at the bank level. So then they turn around and are willing to make loans, especially riskier loans, which again is going to adjust this. But it continues our perpetual debt problem as the world debt level continues it to all-time highs. We now have over $18 trillion of negative yielding debt. The issues are getting bigger and bigger. The bubbles are getting bigger and bigger. But at some point, the question is, apparently there's a reflation trade. I mean, what needs reflating? We have inflation everywhere, especially in the equity and bond markets. The commodity markets are starting to catch up, as we've been talking about from the very beginning on grains. We were very bullish grain prices just because we're like this. That's where we're going to see the biggest issue. And just given some of these economics, we're just the inflation issue, the movement in commodities is only going to continue to get exacerbated. And the question will be, where does the dollar go? Because as it appears, as the dollar goes, so does everything else. And if the dollar strengthens, then that's just going to put inherent pressure on the market and other commodities. But again, these are things that we're watching and reasons why we remain concerned as we go through the remainder of the year and into 2021.